to come back in and talk to you about another strategy that I think we should at least consider for the portfolio, and that is adding an equity, a global equity strategy to the portfolio. Some of the reason we think it's important is it's another way of diversifying some of the risk away or out of the portfolio. Right now, we don't really have any global exposure in the portfolio, and if you've if you follow the economy, the U.S. economy has been doing pretty well. It's been growing since 2009. We had some help with it growing, but it's been growing. Now it's doing fairly well. And the global economy, starting last year, started to kind of pick up and try to catch up with the U.S. economy, and we still think that there's still some room to grow with that. So we think that there's an opportunity. Last year, we think it probably would have enhanced the portfolio to some degree had it been in there. It's hard to say exactly how much, because how much money would we have allocated to it. So what we're suggesting is that we take maybe $3 million out of the current equity position and putting it in with the Capital Group, which is really American funds, if you've ever heard of American funds, mutual funds. This is their separately managed portfolio, okay? And essentially it's the same strategy as the mutual fund. It's just you can see your individual investments. The portfolio itself, and I tell you what, I apologize, but I think we got you the wrong one in your hands. Can I see that one?
This one?
Yeah.
That's the one from the last time.
That's the one from the last time, and I apologize. And if there's any concerns, I can get this right back to you. I was comparing the international equity. That's what you guys have. That's what I put in front of you, just to check out returns versus just global equity. Okay, so what you have there is not really what I intended for you to have, and I apologize for that.
What's $3 million as a percentage, Mike? I'm just doing the quick thumb. 2%?
Yeah, so we're not moving the needle. It's just a way to kind of dip our toes into it and see how it goes. Before I go into, I'll look at these numbers. The reason for global versus international is a global manager can invest in the U.S. if they feel like that's the best place to be. They're not obligated to go overseas, go into other countries and invest all the money into foreign stocks. And there's times, we've had times here recently where a global manager has primarily been in the U.S., okay? But if there is opportunity, if there's better opportunity overseas in other countries, they have the ability to go overseas. And
so they could follow Harley Davidson then, huh?
That's right. That's right. The international, if it was just a straight international manager, then they've got to invest their money overseas, foreign countries, absolutely. Okay, so this gives them, I think this gives, the global strategy gives them the flexibility to kind of be where are we going to have the most opportunity.
Do you feel that that's just to placate me to use the global, because quite frankly, if we want to invest in U.S. companies, we don't need global?
No, it's not for you. It's for the benefit of the portfolio. For our individual clients, frankly, we use a global strategy as opposed to international. With all of our individual clients and 401ks, we recommend global for that reason, for the flexibility that you're not tied to having to be international.
Say something.
Yeah.
So, during 2008, as scary as things were here in the United States with the financial crisis, it was even more scary everywhere else, pretty much. So even international managers, not necessarily funds or money managers like this, but even folks in other countries, we saw monies flooding into the United States because it was considered safe compared to the rest of the world. So what Mike is saying, just to kind of reiterate that, it just allows the latitude of saying, you know what, if things are getting ugly overseas, we're going to kind of pull things back here some, and if there's opportunity, then we'll take some opportunity. And did you have those numbers? It was about 50%.
Yeah, actually,
Got those
and
numbers.
again, I felt really bad that I gave you the wrong book. So I'm just gonna read off of what Jamie's book is. It was the one that we gave you at the last meeting. But the allocation right now, 53% of the portfolio at the end of March was in US and Canadian companies. Okay, so that's a pretty substantial piece. And then 32% was in Europe, and 10% was in Asia and the Pacific Rim. So we're dealing with established countries. We're not, you know, there might be a little bit of India in here, but it's mostly established countries, is what this strategy is.
Do you think, just taking Commissioner Ames's comment a little more seriously, do you think that the tariffs do you think some of the money is going to follow those migrations if they happen?
I think the manager will
Yeah.
be mindful of what's going on with the tariffs and where to be and where not to be, absolutely.
Okay.
It's just an additional expense. I mean, if it ends up taking place, you know,
Yeah.
the way it's being portrayed right now, it's just an additional cost of doing business. So, it's a factor just like anything else, I
And
think
and
would be.
it's a factor for US companies
Sure.
versus
Sure.
foreign companies,
Yeah.
Right.
you know, right now. And we don't know where it's gonna settle.
No, but
But it's- that's a
I mean,
good
just
question.
using Harley as that example, you know, they've obviously reacted for the moment anyway, and reacted and said, well, we're gonna do a little production over here now, over there, in Europe.
Right.
So, it's a lot of-
Yeah. So, I mean, looking at this, and again, you don't have that in front of you now, but the 10-year average return was 7.84%. So that's a pretty good number. The 10-year number, or the 7-year number was 10.25%. So there's, you know, it does give you a little bit of extra return. And some numbers that we look at, we don't always talk about, we don't have the chance to talk about it in our quarterly reviews, but some numbers that we look at is alpha. That's the excess return that the manager is bringing over and above their benchmark. And over the last 5 years, they've averaged an extra 2.14%. So they're exceeding that benchmark. It's kind of what you're paying them for is return.
You're talking about American funds.
This capital group, right?
Okay.
Yeah, yeah.
And what's the beta?
The beta is 0.98. So you're kind of similar volatility, but getting better return.
Do you guys, when you mentioned the expansion of our economy, do you see the next couple of years, do you see it continuing, the U.S. economy?
Yeah, I would say we do, yeah. Yeah, I mean, our growth, you know, for a number of years now has been well below average. Our average GDP growth is, I think, is about 2.2 or 2.5 if you look over many, many decades. And we've been averaging more like 1.5. And, you know, this year GDP numbers are being kind of thrown around where they're going to settle in at the end of the year. We're only in the end of June at this point, but numbers of 3% plus are being still kind of tossed around.
Even closer.
So when you see an economy the size of the United States, that's significant. Those are big, big numbers, you know. So there's certainly opportunity, and earnings, not to get way off subject, sorry, but our earnings,
Yes.
our earnings also are still really, really strong. It's just a lot of the tariff conversation right now is what's kind of dampened things for the time being.
And I agree. I'm fundamentally opposed to investing overseas when we have American jobs and American businesses that I think deserve our attention and our investment. Add to that the tariff situation with the other countries and what's going on at the national level. I think we should run as far away from this as we can. That's my personal opinion.
I mean, I think it's worth us looking at in some respects, as Mike says, we are sort of quasi dabbling in international with the ADRs. Valspar, Bayer, we're stationed overseas, headquartered overseas, but they're traded on the US market. So we're sort of quasi in a global anyway, in a different way. And I think if it's something that's gonna help improve and be a good additive to the fund and the little amount of money we're putting in, I think it's worth us at least going in and looking at it.
Yeah.
I mean, I think it's worth us looking at in some respects, as Mike says, we are sort of quasi dabbling in international with the ADRs. Valspar, Bayer, we're stationed overseas, but they're traded on the US market. So we're exploring it going forward.
Sally, do you have anything that you want to add?
No, not really, but I think too, sometimes we do come to the situation that the global, not including the US, but could be doing better than what we are. So I think it could go either way.
I'm just curious, 2% is, like you said, put your toe in, but what's a percentage that you would look at as for municipal pension, or, what's a?
Well, if you, and I brought along the investment policy, because that's, if you decide that you want to go forward with this, that part will have to be addressed, because right now, the way the investment policy is written, it doesn't allow for it. In our, again, if you were going to go forward with it, we would put in there that it can't be any more than 10%, and our target would be 5%.
But we could actually start out with like the 3 million.
You could start
like
off with
said.
less than that, sure.
No, now you said we're only
Just like in your
2%.
investment policy, we have target allocations, but we don't have to be right on the target, but we do try to stay within the range.
Can you remind me, do we have I don't think we do, but a percentage that we stay within for alternative investment?
We don't have
Yeah,
alternatives in
we
the
don't have
investment
alternatives
policy.
at all.
But REITs, it would be,
That's a separate classification in your policy. REITs could be considered alternatives. We consider it an asset class.
okay.
Been around for a
So we
long
don't
time.
have, I didn't think we did, but I just was curious about that. But
Where would you allocate it from, I guess, or where would you shave a little off of each of the?
We had 3 managers that we would just peel a little bit of money off. If we were doing this, we're actually talking about 3.5 million. 1 million would come from Legg Mason, okay, large cap growth. 2 million from John Hancock, large cap value, and then about $500,000 from CS McKee value. So it kind of not really taking from any one specific one. Sounds like a lot of money, but in the percentage-wise, it's not really taking a whole lot from any one of those.
It wouldn't change your basic allocation of cash, stocks, and bonds either. That's why we're taking it all from equity, since this is an equity manager as well.
So I'm taking this as this is what you're recommending, and so I'm considering it in that light, that this is your recommendation, so that would be good. And I'd be supportive of that.
Just for the record, obviously you mentioned this to us, I think, the last time you were here for the first time. What brought you to the realization that this is something that we should be doing?
Well, the global markets have been doing well, the global economy, and I mean, we see that all the time. We just know where the investment policy stands, that really kind of staying away from foreign stocks where possible. So we felt like we needed to bring it up, at least have a conversation, and if the pension boards feels like it's okay to do and are comfortable with it, that's great. And if you say no, we're not comfortable with it, that's fine as well. But we felt like we had a responsibility at least to kind of present it, because it is part of a general portfolio that we would put together, whether it's a pension plan or whether it's for an individual.
I realize that you're looking at the money aspect, but when it comes to, I'm going to pick environmental. We have very strict laws here in the United States of America that all of our companies follow. You go to some of these other countries, whether it's environmental or child labor law, all kinds of laws they don't have to follow. It's an unfair competitive advantage. Like I say, philosophically, I am against investing in outright foreign countries that we have no affiliation with, that they don't have any jobs here in America or anything. I just think it's wrong. And I have to say that because, if the majority are just solely going on a recommendation based on money, what about the values behind it? How they make that money. That's important to me. And I think American investments somehow connected to America has to be the way to go. That's me.
Well, you guys are staying in America, right?
What's that?
You're staying in America, right, so we're dealing with you, so that's my connection with America is you guys.
Yeah, Joel, I hear what you're saying. I think that the demographics there, you know, the 52% here in the US and Canada, they're developed countries. I think for the most part, they do look out for their employees and child labor and some of those. Maybe some of the emerging market countries, I think maybe, you know, I would probably agree with you that there's some questionable practices there. But the countries that we're dealing with, I would say, are developed and have rules and regulations, policies in place. Maybe not, they're not exactly like they are here in the US, but I think they're probably pretty similar.
And that's it, because we are in such a global economy, that's such a hard thing to avoid. I mean, if you have an iPhone, I mean, Apple has been in trouble different times for their labor law, who puts things together in China and so on. It's hard to completely avoid. It really is, just because everything's so meshed together nowadays with the global economy and so on.
And you have a company like, you know, here, Hershey, okay, they have factories in Mexico. You know, those, that's not where all their business is done, but they do business in Mexico. You know, they're probably facing some of those issues that you're concerned about, but it is a US company.
But I think over half of the employees at Hershey come from Lebanon County. I mean, there's a real tie here.
I don't
It's a big
disagree.
difference.
Yeah, I don't disagree with you there, but I'm just saying a piece of their business they do.
The problem is there's just not many employees in Hershey anymore.
That's right.
Compared to the global production that Hershey does. In fact, that when they built the new plant, it was, my understanding is it was 1 for 14. For every 14 employees that worked in the old plant, one has taken their place in Hershey West. Wow.
There's a list of holdings in the portfolio. These are examples of, this is what capital holds now.
At the end of March, those are the top 10.
So those can be, I mean, those could be researched to see, you know, what kind of, but I mean, some of these are well-known. Airbus, Las Vegas Sands, JP Morgan, GoDaddy. Las Vegas Sands, I presume, because there are casinos and you know, in Asia and things that they're part of. You know, obviously Airbus, we know what that is. Some of them I don't know, but they can be easily researched. I didn't know GoDaddy was a global fund. I think they could be located anywhere. You know,
Right.
so.
Well, and I think you guys represent the values that I have. I know both, Tony as well, but Brett and Michael, you know, value-wise in terms of what, you know our values here in Lebanon. So, I mean, I hate to have that be a measuring stick that, you know, I'm going against values by going in the global market.
Yeah, I was going to say,
Connecting that is.
you're not going to invest in companies in Somalia or Bangladesh or something like that, right?
I appreciate you saying that, because there have been, and there are securities and groups in the past, over the years, that come in and they'll intentionally, this is kind of off subject, but maybe a little bit related to Commissioner Litz, what you're sharing, is your concern with some of it, that will specifically go after certain industries. They'll call, you know, some of the sin stocks, they call them sin stocks, and that's all they invest in. And we would never intentionally bring something like that. I know Mike well enough and Sonia well enough and myself. Quite frankly, Stiefel as a firm would not be a proponent of something like that. So we would not bring something in just for the mere sake of, because the idea with those, what they reference as sin stocks, is it takes advantage of people because they're dependent on something, whether it's gambling or other different industries. We'll get into that. But people that, no matter what their financial state, they're still going to spend money on those different industries, and we would not be a proponent of that at all. So.
That's why I'm opposed to gambling. I mean, it doesn't do me any good to be opposed to gambling, but that's why I'm opposed to gambling, because people, a lot of the gambling money is put out there by people that can't afford to gamble. You know, and to me that's disgraceful, but I don't have any power to change that, so, and we're depending more and more on it now. So.
But really, stocks are part of, is a gamble. And not only that, you have I don't know, countries out there that it says 10% here, and we're missing about 8%. So I don't know what countries they are. And I mean, why do we want to gamble? And we're not fully funded, to my knowledge, at our pension. Why do we want to put money at risk in other countries? If we have to play the stock market, which we do for the pension, it should be in America. It's all about American jobs.
I'll tell you what, though, my counter to that would be the volatility of having so much inequities, and if a correction happens, you know, the more diverse you could be, I would think that would be to our advantage, as opposed to being too homogeneous. But I mean, I don't, this isn't my day job, this stuff, so I don't really am about that deep in it. But you know, that would make sense to me. And you know, in '08 or whenever the last big correction was, you know, some people lost 40%. And but anyway, would we be bringing this up at the next public meeting and to
Well,
entertain it?
if there's enough interest, they could prepare a change to the policy to prevent, if we adopt a change to the policy, then the